Welcome back to Vantage. Energy transition is on all of our minds. We're looking at a trust that invests in this space and a manager who's facilitating it. He's based in the UK. Let's go take a look. Welcome back to Vantage. We are taking a look at an energy transition play. Delighted to have Tom Williams, partner and head of energy infrastructure at Downing Renewables Infrastructure Trust, join us today. Tom, welcome to the show. I think your first time. Why don't you introduce yourself and the fund that you run?
Well, first of all, thank you very much for having me. Delighted to be on the show. Yes, my name is Tom Williams. I head the energy and infrastructure practice at Downing, and here today to talk about Downing's Renewable Energy and Infrastructure Trust, which is an investment trust listed on the main market of the London Stock Exchange. Yeah. We're an Article 9 fund. That means we invest to make an impact. We have an impact as part of the aims of the investment strategy of the fund. And the impact that we're trying to have is to try and assist the transition to net zero. Okay. So what do we invest in? We invest in renewable energy generation assets and other infrastructure assets, predominantly providing services to the grid to enable greater penetration of renewables. And we have a mixture of assets across various different countries. We have some solar in the UK, we have some wind in Sweden, and we have a large hydropower portfolio, which is about half of the assets, also in Sweden, alongside some grid services and grid businesses.
Excellent. And when I read the fund literature, there's quite a lot of emphasis on fund diversification strategy, which seems to be very important. Could you explain what the strategy is and how you go about doing that? Is it by technology, region, type of contract?
Yeah, absolutely. So when we started up the vehicle, we spotted a space. The space was around having a diversified set of renewables assets. So, and why is diversification important? Each given technology depends on a given natural resource. So solar, sun, wind, you get it. Each of those natural resources has a pattern, a seasonality. If you think about things, it tends to be a bit windy and rainier in the winter, for example, than it is in the summer. And so by combining these different technologies with different generation profiles, different revenue profiles, what you end up with is a smoother, more consistent, better quality of revenues in the fund. Okay. And then you diversify by technology, you diversify by geography, so that, for instance, it's not always windy in Stockholm as it is at the same time in Surrey. You diversify by geography, you access different energy markets. Those different energy markets have different drivers. They have different prices at the same times. By doing this, you can just further increase that diversification, further strengthen the resilience of the revenues and the cash flows, and we're really seeing that coming through in the fund today.
Okay. And I mean, let's talk about the opportunity. I mean, when you're looking at your universe, where do you see the greatest potential currently and in the future, both on the sort of technology side and from a geography perspective?
I think it's quite clear for us. We have about half of the fund, as I said, invested in a hydropower portfolio. That's 35 different hydropower plants all across Sweden. We see the greatest potential within that portfolio and within the strategy that we're pursuing. And the strategy, very basically, is to buy small, slightly unloved hydropower plants, aggregate them into a much larger whole, and gains a lot of efficiencies in the way that you can operate them, the cost base of operating them. It's much cheaper, for instance, to obtain insurance across a large portfolio than it is on 35 single assets. And you gain a benefit from that. Then these hydropower plants have been around for a long time, often 80 or 100 years. So we modernise them. And by modernising them, we can operate them differently from how they've been operated in the past. And what do I mean by that? I mean, we can just make them a bit more reactive. We can increase production sometimes and decrease production because we have reservoirs. And by doing that, the modern markets, the modern energy markets, are volatile. They have periods of high pricing, they have periods of low pricing. by being able to modernise the plants, operate them differently, use the reservoirs that we have, we can reduce production when times are low, and we can increase production when times are high. And so you can, by modernising and operating them a bit smarter, a bit differently, bit of elbow grease, you can make better returns from those same assets. And we're just on the start of the journey here, and we're already seeing that coming through.
Yeah, no, that's really interesting. So you're actually genuinely sort of adding improvement and value to the assets that you're investing in. You have a lot of assets, so over 4,500, I think, when we were looking at it. How do you manage that? And in particular, are there any sort of flagship assets that you want to draw people's attention to?
Well, Downing does manage a lot of assets. Actually, the broader business, energy and infrastructure business in Downing, actually manages just under 10,000 assets. So yeah, there are a lot of assets. There are also a lot of people. So we have more than 60 people dedicated to just energy and infrastructure in Downing. And about 30 of them work in our asset management business. And all they do day in, day out, every day, is to look after the assets and preserve value in those assets for our shareholders. So there is a large and dedicated team looking after them. We also are fortunate because we have those people within Downing. We set that business up especially to do this, and therefore they have bespoke systems, they have a way of working, a set of systems and processes, a set of IT that enables us to be able to effectively manage all of those assets, to see what's going on in real time in all those assets, and to be able to interpret and analyse the data coming from the assets in a way that allows us to take swift and effective action. To give you an idea of the data that comes off these things, we get about 3 billion data points a year from the assets that we have at present. So it's not a question of going through every little bit of data and trying to work it out. You have to have a very effective set of systems that flag and analyse this underlying huge amount and wealth of data and show us and point us towards the actions that we should be taking.
Yeah, and in terms of the actual trust, are there any particular assets that people, we describe the concept of flagship. Let's define flagship as either a significant contributor or significant potential. Are there particular assets that you draw people's attention to?
Yeah, well, look, I think with the strategy, of course, every asset has its place. But I think if you were to ask me where we are spending a lot of time when we see the most value and potential, I come back to the hydro portfolio. Alongside that modernisation programme, that aggregation strategy, we also have some interesting opportunities that are created just by having those assets. So, for example, they own the land upon which they are situated. So we have hundreds of acres of land in Sweden, often rural Sweden. And we have 35 grid connections. Often these assets are quite old. The grid was built to the asset, it's next door. So if you've got land and you have a grid connection, then maybe you can put in different types of assets on your land that connect to the grid. So maybe it's some solar, maybe it's some batteries that you can put there. Why would you do that? Well, it's cheaper for you to do that than to buy a solar park from someone else because you already own the land. You're not paying a landlord on an ongoing basis. The grid connections nearby, it's much cheaper to connect to a grid that's closer to you than further away. There are all these opportunities that if you have the time and the willingness to do it, you can take advantage of.
Okay. And the fund launched, I guess, at a time where, for most of us, inflation wasn't really a big issue. Like I said, 2023, you suddenly saw the resurgence of inflation. Love to understand how you manage both the inflation risk and also the general market risk, and what percentage of your assets have, fixed price offtake agreements built in.
Well, the first point to make is that inflation is a huge driver of value in the portfolio. We have a lot of assets that have direct inflation linkage in their revenues. And so whether it's an offtake agreement or whether it's in the UK government subsidy, a renewable obligation certificate or a feed-in tariff in our solar assets, they are explicitly linked to RPI. So our investors have hugely benefited from that over the last 2 to 3 years. And that's been a huge positive and a huge driver of returns. At the same time, we have increased the discount rates in the fund, which were already perhaps a little bit higher than our peers. We've increased them even further to reflect the fact that people want a higher return in a higher interest rate environment. Yeah. And of course, increasing interest rates is the response to inflation. So I think overall, the way that we think about it is that actually inflation is a plus. Now, we also have a strategy to try and hedge both our inflation exposure and also our interest rate exposure, yeah, and also our revenue exposure, or our energy markets exposure. And so you asked me a question about do we have fixed price arrangements in our PPAs, or do we have what do we have there? So on interest rates, we don't have any exposure, any meaningful exposure out to 2032. All of our debt is swapped, and actually it's swapped at quite low historic rates. So, yeah, so we're very fortunate there. Yeah. On revenue exposure, about 75% of our revenues in the UK are fixed for the next 10 years. Okay. They are fixed, but they do increase with inflation. Okay. And we have overall in the fund just under 50% of our revenues fixed for the next 10 years. Okay. So it's a good balance of that underlying fixed set of revenues and some exposure to market energy prices, so that we can, for example, with the hydropower portfolio, take advantage of those periods when prices are higher. Yeah. If we don't have that market exposure in Sweden, then that strategy is less valuable. You wouldn't be able to take advantage of higher pricing when it arises.
The way when you're looking at the assets, in particular how you sort of fund them, so as opportunities come into the fund to invest, how do you think about the right mix from a sort of debt and equity perspective? What is your formula for that?
We actually normally favour pretty low leverage. Okay. So if you take the hydropower portfolio, for example, I think we're at about a sort of 30% leverage. The assets could take a great deal more leverage, but we don't like to do that. Overall, in the fund, we're around about just in the high 30s, just under 40%. Mm-hmm. The reason for that is that we acquired some solar assets. So solar assets with legacy solar assets have subsidies. Those are fixed inflation-linked revenues. Solar's a very predictable generation. We've been studying the sun for a very long time, so we kind of know when it's going to come up and know when it's going to go down. So the revenue streams that tend to come off those are very stable, and so therefore they can take more leverage than other assets can. Okay. And so when we acquired them, they had leverage. We kept that leverage in place, and then we've taken out leverage as we've acquired the hydropower plant. So that's how we think about leverage. How we think about asset selection and how we use our capital is a really important question for investors at the moment. And we recently, in our annual reports, published a decision-making matrix. We try to explain to people how do we make difficult decisions at the moment about where you put your capital. Yeah. If the fund is trading at a discount like it is at the moment, mm-hmm, and we discount our assets, so that the return that we expect from our assets is 8%. Given where the fund is trading at a discount, actually the implied returns if you invested today is 14% if you were to buy a share. Yeah. So we have a share buyback program where we're buying our own shares because we think that is a very effective and efficient use of capital. Yeah. Why would we not buy our own assets that, yeah, we're happy to buy at 8, yeah, at 14s? Yeah. But there are some opportunities within the portfolio where we can exceed 14%, mm-hmm, with the target that we're presented with. So, for example, the modernisation program I was talking about with the hydro, we can operate them a little bit differently, and there's a frequency market emerging in Sweden at the moment. Yeah. So for very little investment, you can create a whole new set of revenue streams that was not in the original investment case at all. Yeah. That's obviously a huge benefit to our investors. that could be as much as a 40% return on the capital that we invest. So it makes sense for us to do that as much as we can.
Yeah.
There are other opportunities like putting batteries alongside the hydro, for example. We don't want to invest in a lot of batteries, but there are some discrete opportunities where we think that might be worthwhile. Again, you might get a 20% return. So all of these things we sort of constantly look at as a matrix of how you make that decision and where we can best deploy the capital that we have.
Yeah, okay. You've kind of answered the next question which I had in my mind, which was, given the discount, how do you sort of, what's your strategy for growth? Which, listen, let me summarize what you said to me, which is you actually see quite attractive proposition of buying your own shares. What is left is then things that either exceed that hurdle rate or require very little sort of investment to actually open up new revenue streams. Is that a fair summary of the growth strategy?
Yeah, that's exactly right. And I think that's where perhaps we differ from some others, because with that hydropower portfolio in particular, it is very operational in nature. You can make improvements to that portfolio to get greater revenue, that's much more difficult to do with a wind farm or a solar park. There are just limited levers that you can pull in those kinds of assets, whereas with something like the hydropower portfolio, perhaps also with the distribution grid that we own in Sweden, which is the network of wires that connects your house to, for instance, a power station. We actually own the wires there. That's a regulated asset. It's a monopoly. You have to use it. You don't have a choice of choosing somebody else's wires to transport your electricity, so it's exactly the same as the UK. But you can invest in certain programs, certain modernisation, certain improvements in those sorts of assets and make a better return. And that is quite difficult in kind of other core renewables like solar or wind.
So in addition to the attractions of the discount, and the fact that you're buying back shares, you also have quite an attractive yield on the trust, which was 7.7% when I was sort of calculating it. What is your sort of messaging in terms of how you plan to sort of maintain that and move that forward, and how well covered is that dividend yield?
Yeah, well, I think we're quite proud actually of our record on dividend. So we IPO'd in December 2020. At that point in time, we said, look, we're all in cash. It'll take us a while to invest. First year, we will only pay quite a modest dividend. Actually, after 6 months, we'd invested in a good set of assets. They were operating well. We actually increased the dividend at that point. Then after the first year, we increased the dividend by a touch over 5%. In fact, it was about 7%. And then this year we've increased the dividend again by a touch over 7%. So we are progressively increasing the dividend as that portfolio matures. We've had the confidence this year to increase it by more than 7% because of the way that those assets are operating, because of the way that we can see the operation improvements that we're making, for instance, in the hydro coming through and generating more cash in the future. And so that dividend, as it stands at the moment, I think our forecast is around about 1.35 times covered over the next 3 years on average. And that has progressively grown. Our dividend cover has grown each year, year on year. And we think, and we hope that will continue to be the case.
Tom, it's been a huge pleasure having you on the show. I love hearing the sort of the story that is enabling that sort of transition to net zero. I hope we can get you back, and by then, the efforts that you're putting in to, unwind the discount have paid some more dividends. Thank you very much for coming on Vantage.
Yeah, thank you ever so much for having me.